All right, welcome to another Rocket Dollar webinar. Happy that you're all here and attending. Just right away, I'll say this will be recorded and put on YouTube. So if you put in the chat, is this being recorded? We will say yes, as always. Tell your friends who always email us about that. My name is Brendan Walsh. I work in sales and partnerships at Rocket Dollar. I'm sometimes answering the supporter sales phone. And the reason that we do these webinars, if you have never been to one, is a lot of our clients will tell us, hey, I know this asset class really well, Brendan, but I'm really looking to learn more about the greater alternative investment options out there. I'm looking to gain some more wider breadth of expertise, or I already know this asset, but I'd love to hear other people talk about it and maybe share ideas that I do not know. So we have two guests here today, Ryan Beatty, who you've met before. Ryan, why don't you introduce yourself?
Yeah, so you might have seen me on here talking about assisted living as an asset class, or perhaps self-storage or some other things. And really what I see my role in this space as kind of like what Rocket Dollar is doing, which is educating and providing access to things that investors may not know existed, or maybe they knew existed, but they didn't know they could invest in it, or even how to invest in it. And so today, another thing that I'm super excited about, which is investing in learning about investing in post traction or post revenue tech startups, with a friend of mine named Kanth. I'll let Kanth introduce himself.
Thanks, Ryan. Hi, everybody. My name is Kanth. I'm based out of Dallas, and I originally started off as a engineer and a geek. Have an undergrad and a master's and PhD in computer science in AI when AI was not as popular as it is today. And after a brief stint in working for corporate America, I became an entrepreneur and built and sold a company. And since 2007, I exited corporate America. But a couple of years before that, around 2005, 2006, I essentially started angel investing, and which has now converted itself into raising money for startups via syndicates. I think it's an important asset class that many people don't seem to have access to. Like I did not. I stumbled on it accidentally. And so I align with the purpose of both Brendan and Ryan. My hope is to quote unquote share some of my learnings and education over the past 15, 20 years with all of you on why this asset class is important and how you can get into it.
Great. And then I've got your slides ready, or Ryan or Kanth, you want to be the one clicking through the slides? Do you want me to pull them
up? Ryan, you want to do that, or how do you want to do this? I'm pretty
the other night you kind of led that, and I think since you'll be doing most of the speaking, I'll just be interrupting and asking questions that come to my head.
All right, so you have screen sharing enabled for your Kanth. There you go.
Okay. Can you guys see my screen share?
Yep, we got it.
Yes.
It was in the wider view just a second ago. This one is totally fine if you're more comfortable with that.
Say that one more time, please. The full screen is better?
It wasn't a full screen view just a few seconds ago. This one is also fine if you just want to scroll up and down.
Let me just use that 1 second. Yeah, I'm going to use full screen. Is that good?
Yep, we're good.
Yes.
Okay. Yeah, we're going to talk a little bit. Shall we just jump in and go back and forth between us, Ryan? Would that be good?
Yeah, I think that would be great. While you're clicking onto the next screen here, I've known Kanth for a number of years now, and one of the things that kind of got me interested in this space, which I have been looking at on my own for years, on websites like, I believe one's called Start Engine. I have no idea how to vet these things. I don't know anything about these kind of like startups. I feel like I would just be closing my eyes and picking a random one. And what resonated with me as I spoke to Kanth was he talked a lot about his experience and how he started investing in startups, some of the issues that he had on the front end, and how he developed a process into selecting startups to invest in the future. So we'll be talking a lot about that today. But I just wanted to give some background on, like, I am the average, at least I imagine, average investor looking at this asset class, like, how would I ever select one without just closing my eyes and picking a random one that spoke to me? But I'll let you go ahead, Kanth.
That's great. I just this is the title, Trust the Process. In the beginning, I had no process. I was stumbling around, and how to invest in post-revenue tech startups. I think each of these words has a meaning to it. Startups, we are looking at early stage enterprises where maybe there are 3 to 5 people that are coming together with an idea. And maybe this is one of those garage type of startups that you hear about. And specifically, given my background, I was interested from the beginning in tech startups or tech-enabled startups. So a tech startup would be something like an HP or a Microsoft or Google would all be considered as tech startups. A tech-enabled startup would be something like Airbnb or Uber. So those are tech or tech-enabled startup. Post-revenue, when you start off, you have no revenues. You don't even have a product, and you start coming together as founders and you build out a product and take it to market to see if somebody is willing to pay for it. That is an important point. Before revenues and after revenues. Before revenues, startups tend to be extremely risky, as I will share in some of my stories. And the next one is, how do you find these startups, evaluate them, and invest in them? So over the years, I called it going through the college of hard knocks. I kind of learned a set of principles that have been converted to a checklist we currently use to select startups to invest into. So clearly, neither Ryan nor myself are investment advisors. Please don't consider this as investment advice. Our goal is to educate and probably tell you about this asset class. And truth be told, it's a very risky asset class if you don't know what you're doing. And I have seen myself, I have lost all of my money in some of the investments I have made in this space. So you should be extremely careful and do your own due diligence and maybe consult your financial advisor before making investment decisions. And our past performance is also not an indication of future results. Yeah. Should I just tell stories of the companies?
Yeah, I think what I would start with, rather than, because these are more companies that you've invested in a bit more recently, is talk about how it started. How you started getting into this asset class and what those experiences were like and what some of those hard learnings were.
Okay, that's great. So it started off around 2005. Like I showed you in my background profile, I went to a place called IIT, and many of the people from IIT are in the US, and we all tend to have a community. And one of my seniors from IIT reached out to me and said, oh, there is a healthcare startup that I'm investing in. I recommend you do the same. And I respected this guy a lot. And I said, oh, that's a great idea. And it turns out it was an extremely early stage startup. I was living in Chicago at that time. I went and met this person. He had gotten an education and an MBA at Kellogg. He also was from a different IIT, and I could see a lot of synergies, and I could see that this person was all in. So I decided to go ahead and invest in that startup. And that was my first investment. And I was totally clueless. I was like a green behind my ears. I had no idea what I was talking about. I did not know what questions to ask. I did not even realize that they were pre-revenue. That shows you how new I was to this field. And there were many yellow flags and red flags that I ignored. I did not ask them who were the other investors that were on. I did not know what the valuation was I was getting into, how much percentage I owned. And when one of the co-founders drove to my house to pick up the check, I should have recognized the warning signs that these people were desperate to get the money, which is another sign that you really want to pay attention to. Needless to say, I never saw that money again. But that was my first investment. But luckily, I was not like the the cat that sat on the hot stove and said, I'm not going to sit on any stove, hot or cold, ever again. This was, it just made me realize that, okay, I know that startups are growing and people are making a lot of money here. It looks like I just don't know what the heck I'm doing. Let me start learning. That was the beginning of my learning process. That was not my last lesson learned, but that was the beginning of my learning process. Yeah.
Yeah, and that as an investor, you really, you can't always be too gun shy from learning from other people's mistakes, but you should try and learn from other people's mistakes. And there's often this very invincible type of feeling that investors feel until they are personally burned. And it happens in every different asset class. So do your best to learn from other people really getting burned strongly. And just to give some context, some of our investors, when they come into here, they're looking to do these investments through a self-directed IRA. So these are retirement funds that people are looking at that could be a part of a traditional or Roth IRA. So you need to understand that this is a high-risk asset class. But why do people go take these risks? Well, they see, some of these startups, if it works out well, if it's a 5 or 10x or better, they're really hoping to protect that large capital gain inside of a self-directed IRA. And even more people are trying to do it in a Roth IRA now, because then if that gain is in there for 5 years, there are no taxes. So sometimes I see investors when they're coming to us and they're excited to invest in startups, they kind of lose perspective on the risk level, and they go, oh, I want to get these 10 startups. And then we say, well, how much of your portfolio would that be? And we're not advisors, but just trying to help them out when they're opening the account, and they'll go, oh, I didn't really think about that. I'm going to bring all these dollars. And said, okay, maybe start with a smaller amount, or measure it to the risk you're taking. Maybe it's just 5, 10, or 15, or 50 grand, whatever works for that client. That if they lost all of it, they would be fine in their retirement plan. So Kanth, please continue. I just wanted to give that retirement context that people come to us with.
Yeah, and before you continue, Kanth, that's one of the reasons why I felt like this was an interesting thing to consider for your audience in particular. As you mentioned, learning from other people's lessons, I've personally had a lot of hard investing lessons over my career, and that I feel like the people in my audience have learned from. And learned alongside me with in the earlier days, and those kind of like higher return potential get people really excited. But you can also go through the learning lessons, like having an owner pick up a check from you at your door, like Kanth learned it years ago, or you can have some of these like potentially better experiences, like he's had more recently. And I'll let you talk about these experiences, Kanth.
Yeah, again, you need to have some kind of an asset allocation formula. For example, most of these investments, if not all of them, are generally open to accredited investors. And this is what I would do. I'm not recommending this, but if I had $1 million and let's say I decided that I'm going to $1 million that I'm investing, I might say, okay, I'm going to allocate $100,000 to this startup world, and do what Brendan said, try to learn from as many people as I can and make the best investments that I can make with that 100,000. And I would probably spread that across maybe 10 to 20 companies. I might invest $5,000 per company in 20 companies, right? So that would be 5,000 times 20, about 100,000 invested. Because while this is an asset class that is not correlated too much to the stock market and other real estate and other asset classes, so this provides a good diversification because it has a low degree of correlation with other investment classes. That's one of the reasons we like this. And second is there is a possibility of generating, like I said, I got burnt in the beginning, lost a lot of money. But at the same time, once I learned a set of principles and did not deviate from them, I saw much more consistent success. And you could, like Quick was a company that was started by one of my friends, literally out of his garage. And that investment generated about 8x in results. Jungly Games was 15x. Helium is something that we could not get in the early stage, but in tokenized asset, they kind of come out to the market and quote unquote are publicly available, but extremely difficult to get a hold of. So we had to reach out to a person called Omar who was in Europe and do a private deal to get access to helium tokens very early. And we are currently sitting at 20 times the money, and we're still not selling because we're seeing a lot of traction. The same thing with Mixerbox. And I put Dillmill in there. Dillmill was usually in startup asset classes, you get three different kinds of exits. There are companies I invested $25,000 or $50,000 and I got zero back because they went bust. Or there were companies like the other ones that I talked on this slide where we made a multiple X return. That's great too. And sometimes there are companies like Dillmill, which are a great company. They have an early traction, and for some reason maybe there is competition, the traction dies off, but they're a great team. So another company wants to acquire them. They're called acqui-hire. And usually they buy them out for the investments that have already been made. So I invested 50,000 in Dillmill through Rocket Dollar, through my IRA. So which is the reason why I wanted to put that out there. And in the case of Dillmill, I got my money back a couple of years later. So I just wanted you to understand the phases. First, there's this phase of figuring out the allocation that I wanted to do to this asset class and how much I wanted to invest per company. And on an average, I was investing 50,000, sometimes 100,000. And then there is a waiting period. Typically it's 3 to 5 years. And then most of these companies tend to exit via acquisition. Quick got acquired, Jungly got acquired. Helium is already a public company. Mixerbox more than likely will be acquired. Dillmill was acquired. So 9 out of 10 times they get acquired, and that's when you get your returns. So there is a period of waiting where your investment is illiquid, right? So these are the things you need to understand. So you literally cannot get your money out. So that's if you're looking for a negative side, the fact that it is illiquid for 3 to 5 years is a challenge. But on the other hand, in a funny way, that was money that was protected away from me. I couldn't spend it. And every 3 to 5 years, I would get a multiple X back because of the investments I made a few years back. And now when the money comes back, I take a portion of that and continue to reinvest in this asset class.
Yeah.
I hope that's making sense.
Yeah, and part of those stages, something that we've added at Rocket Dollar in this last year too, is we got complaints from some of our clients is at the liquidity stage, is they would have a great investment. They would get close to an IPO or an acquisition or something like that. And then that team would not understand the self-directed IRA. And they'd run into this trouble of they want to sell their shares as quickly as possible. Obviously, they're feeling the pressure to do so, but they're still dealing with like an administrative something over actually getting liquidity for their shares. So with our new custodian and being embedded with them and everything like that, we have a lot more resources for someone that has a liquidity event or their shares go public. And if you haven't talked to us about that in a while and that happened to you, please let us know as early as possible, because we do have a good flow for you to go through now that's much less frustrating than it used to be before.
That's
yeah. Kanth, before we move on to this next slide, early on, your check marks were, I know this person, they went to a good college and they're investing in it, which are, decent, not great. But what are some of the things that you started to add in as you learned to make sure you're not just investing because you like the person?
That's great. So, like I told, I didn't include the list of all the companies where I lost money early on, but I talked about the healthcare company. There were 2 healthcare companies that I lost money with, and another one was in digital security. So there are 3 companies that I basically lost my entire investment, but those 3 got me my MBA in this. So if you look at, so Quick was one of those early investments that I made, but I just turned out to be lucky. So this investment, even though it was pre-revenues, it turned out to be one of those companies that actually generated revenues and ended up getting sold. But if you look at Jungly Games, by that time, I became a little smarter. Jungly Games had raised money at sub $10 million, probably at $4 or $5 million in a very early stage, pre-revenue stage. I did not invest in that. And when I came to know about Jungly Games, they had a valuation somewhere between 10 to $15 million in valuation. So it was like 2 to 3 times what it was in the previous round. But by now they had revenues, they were generating profit, and the business model was pretty clear. So I went through Jungly Games. I talked to the founder. I got the presentation and the pitch. I went through the revenues. So I had a slightly more significantly longer list of things that I looked at who were the other people that had invested in that company and checked out their profiles. And I also figured out that they were in gaming early stage, and they were based out of US, but they were building these games for Indian market, where I also checked out the market and saw that these games were growing like crazy. And so those were all the due diligence type of things that I did, and realized when I talked to several people that I knew in India, they said, well, gaming is just beginning. And I looked for what is known as a blue ocean, right? Red ocean is where there are too many competitors, and a blue ocean is where there is really an upstart on the horizon that there's no competition to. So that's how we invested in Jungly Games. It was the exact same thing with Mixerbox. Mixerbox was a music app that was being rolled out in Taiwan, had revenues, and they were doing extremely well. That's why we invested in that. And it turned out to be it later on became one of the top music apps in all of Taiwan, et cetera, et cetera. And they raised a bigger subscription round at 10 times the money we put in. They're doing very well. Helium was a very interesting story because Helium came out of the Web3 world, and it was a tokenized asset. And so what they were essentially doing was I could set up a hotspot in my attic, and it would give a signal where if some dog was lost and had a dog collar, it could detect that, because generally out there is no signal. But these hotspots would extend the Wi-Fi signal by half a mile. I thought it was a great idea. We looked at traction on the supply side, and we saw hundreds of thousands of these hotspots being deployed. But it was a bit risky because we were looking at traction from a one side alone, which is supply side. There was still no demand to buy the bandwidth. So you cannot look for perfect scenarios. We knew that eventually, again, saw the team, evaluated the model, looked at what they were doing, and also looked at what they were planning to do next if this did not work. And if the IoT did not work, they wanted to go into Wi-Fi signals and cellular bandwidth, and which was a great thing because we invested in them. They kind of went up and down because there was no demand for it. Then they rolled out 5G and Wi-Fi hotspots. Now my entire cell phone service is from Helium at $20 a month. And my phone is also a miner, so it mines the tokens from Helium, and which are worth more than $20. I'm getting paid for using cellular service through Helium and T-Mobile. So that's why we are literally sitting tight, because we saw traction of 25,000 people using this cell service in January. Now it is over 85,000. So we're just literally going to sit tight because this can literally go into millions of users because it's an extraordinarily high quality, affordable plan, and it is global. They had a partnership with Telefonica, Google Pixel phone, and so on. So you're looking at how we not only get into it, but keep tracking it, because there's no reason to get out early in such opportunities. Hope that's adding a bit of color to how we invest. We're also very picky about valuations, because recently we had somebody come to us with about 300,000 ARR. In fact, that's one of the active syndicates that we are currently running. And they had a valuation of 53 million. We said, that's extraordinarily high. Their valuation was high because their pipeline was huge. But we just said, we are not desperate. We are not going to be emotional. We stuck to our checklist and we stayed out for a few months, which was very good because their valuation came down, because once they realized that it was too high after talking to other investors, their valuation came down and their revenues went up, which were both good evidence for us to invest into.
All right, great. We're about halfway through our time. Why don't you keep going?
So can I talk a little bit about the risks generally that we look for in addition? So there are avoidable risks. like I said, but then there are not so avoidable risks, right? That is, there could always be competition that you did not expect. And the other risk is I already told you about illiquid asset base, right? And the other reason why people who like this still don't get in is because entry is hard, which is the reason why I was an angel investor, just investing my money for maybe 15 years or so, and more recently started doing syndicates or special purpose vehicles, so that all the effort that we are putting into deal sourcing and finding the right deal, we decided that it's a better idea to open these up for other investors, because these are generally hard to find.
Yeah, and I do want to talk quickly on what a special purpose vehicle is. So just so you know, if you're not familiar with that, let's say a fund needs $1 million, and they're like, well, we only want investors $1 million and above. And you're like, well, I only have 75,000. I'm never going to be able to do that. So sometimes investors will create what they call a special purpose vehicle, which is usually just an LLC with a special name just for this one time. And you will join into that LLC with maybe 5, 10, 15, 30 other investors. Now, all of a sudden, you have over $1 million to enter this fund. So your access has gotten easier, and you can get into that. You can do an SPV through a self-directed IRA. You have to be careful how you set them up. Usually, you don't want to be the one in charge of it if you're going through your IRA. It's better if you're like just one of the people jumping in on it. Because there's so many rules about when you manage things for a self-directed IRA. So if you see people putting SPV, that's kind of what they're talking about. If you have a question about that, just contact Rocket Dollar. We can typically easily service an SPV. The custodian just might ask for a slight extra detail of, yes, this is your SPV LLC, but what is that going into 2 to 3 days after you finish it? They might want to know the end result company as well. Continue.
Oh, that's great. Thank you. And informally, sometimes I've heard SPVs being referred to as syndicate also. Yeah, as a FYI. Yeah, Ryan, do you want to dig into the example that we have currently, the live opportunity?
Yeah, of course. I think it's a great way to learn about what something like this would look like, so that you have an idea of what this looks like if you've not seen something before.
Yeah, let me just jump in and give you an example. In enterprises, a data loss problem is a big one. You guys might have heard of Experian data breach a few years back, and which is literally collecting millions and millions of financial data. And if something like that has a central database, imagine you have millions and millions of user accounts in a centralized database. That centralized database is like a honeypot that hackers try to get into, because once they get in, they can get access to millions of accounts. In 2023, there were 2,800 plus data breaches costing over $10 billion. So instead of putting all of them in the centralized location, you chop them into small pieces and distribute the locations, literally put them in every individual user's account. So if a hacker hacks into an account, they get one user's information, not 10 million users' information. And although that idea was not new to us, we have seen that idea shared with us before, and that's why I was very skeptical. That's why you see the last sentence on this. The reason they're able to make it work and generate revenues is they did not change the user experience. In the past, when we saw people bring in a decentralized architecture, there is no concept of, remember, we all have a login and a password and multi-factor authentication. And if we lose our password, there is something called forgot password we can click on. Now, generally in decentralized system, there is no concept of forgot password. If you forgot your key, you lost access permanently. And that's the thing we did not like, because no enterprise would adopt such a technology. So what these people did was, that key that you cannot afford to lose, they hid it from me as a user. So when I log in and I do multi-factor authentication with a code on my phone or by email, it unlocks that, what is known as a private key, which should never be lost. So they don't even show it to me so that I cannot lose it. And they use that to decrypt. So in encryption, this information on this slide, for example, you're able to read. If they use a key and encrypt it, right? That means you cannot read it anymore. You cannot, it's encrypted. And you can use the same key to decrypt it. That means you can again read it. The key is your security. If you hide the key, nobody can read the information that you have. So the most important thing these people did were the last two things. They did not change the way I logged in, and they did not change the speed with which I log in. Before, when they used blockchain, this is all called blockchain technology. If you bring in blockchain related technology, either you could never lose the private key. That means if you lost your password, you're done. Or the speed is horrible. It takes like 30, 40 seconds to log in. So they eliminated those two. And that's the reason why their first client was Warner Brothers. And they have about 6 or 7 projects going on at Warner Brothers. Because once you re-architect something from centralized to decentralized, a whole host of new opportunities will show up. Like some of you, I'll give you a second example here. Early on, Netflix was very relaxed about if you got a Netflix account and you shared it with in my case, I shared it with my daughter in Austin. I live in Dallas, and with my son in Oklahoma, which was fine. But then Netflix came down and said, hey, you can only use our account in one IP address, one location. So now in my family, we have 3 different Netflix accounts. And this company realized that with decentralized architecture, it is very, very easy to implement this kind of a feature, and they called it access management. And they are now built out a general solution that any B2C, any business to consumer company like Netflix can use. And they did the same thing with loyalty and rewards. Imagine now you took the central database and chopped it up so that I have my own data, and my data is in my space or my Google Drive or my enterprise drive. They call it a wallet, but don't think of the wallet as something small that holds your money, but think of it like a huge amount of space that's encrypted. Now, generally, loyalty and rewards are in the control of the company that's giving them to you. They say they are your points, but they can take them away because they control it. But now when you have your own wallet and they drop your loyalty and rewards into your wallet, they're truly your own. They're like your money. You could even sell them. Imagine you take your frequent flyer miles from American Airlines and you sell them, and somebody else buys them and gets enough of those points or miles to fly free from Dallas to New York and back, or for a low price. So it's extremely advantageous. So they have a significant amount of companies in their pipeline that want loyalty and reward solutions. Finally, the last use case on this slide is opioid drug prescriptions, which are extremely addictive. They patented this whole thing. They have an end-to-end patent with a law firm called McDermott, Will and Emery. So that's a famous law firm that came to Frontier X, partnered with them, and filed this patent so that opioid drug users who take a prescription and try to refill that in multiple locations, the same prescription, once they redeem it in one location, they toggle the ID on a blockchain. That means you cannot tamper. It's a tamper-proof ledger. So once you have toggled the ID, you can never refill that prescription again. So that's an extremely important use case. So we like the fact that they have so many use cases. Each of these is potentially a huge market, and they're also continuing to generate revenues. Yeah.
Okay.
Here is a revenue traction.
And
over
could
the
I just
last.
pause quick, Kanth? We had a question. So someone asked what a safe note is, a safe agreement. And they asked kind of when we were talking about SPVs. So I have the standard definition in front of me, but if there's anything you'd like to say about what a safe is before we continue.
Yeah, I think it was popularized by Y Combinator. It's called a simple agreement for future equity. What happens in very early stages is it's very, very difficult to give a valuation for a company which is pre-revenues. And so instead of giving a certain valuation today, they say, you know what, I don't really know the valuation of this company, so I'm going to use a SAFE, which is a simple agreement for future equity. And normally it comes with 2 numbers attached to it. One is called a cap, I don't know what my company is worth today, but I know it's not worth more than 15 million. So they'll say the cap is 15 million. That means if they raised a valued round in future at $50 million, you will still get your shares at 15 million. Oh, let's say $60 million. So let's say they raise money at $60 million. I'll still get my shares at $15 million because that was the cap. So that's one number. The second is called a discount. A discount happens if they did not raise the next round above 15 million. Let's say they raise the next round at 10 million, which is below my cap. Then I will get let's say the discount was 40%. They raise money from other investors in future at $10 million. 40% discount on 10 million is 6 million. I will get my shares at 6 million. So this is a way of protecting me, but not really giving me a valuation until they raise the next round. And based on the next round, they will calculate what my valuation is. I hope that's helpful.
Yeah, and
Brendan, but go
that
ahead.
is, that is a great description. And I think, thank you for asking that question. And one last point is just, a lot of people compare it to a convertible note, because startup investors, you're either usually investing in equity, stock that you're hoping appreciates, or you're investing in debt, where debt really has a very clear start and end. You're starting at the beginning and you hope you get a certain amount of interest at maturity. And with a safe, there's a lot more unknowns in that. So, you just have to be aware of that as an investor, that, some investment contracts have very clear beginning and end dates and very beginning, expected returns on that. With something like a safe, you don't really know, other than those conditions, when those might trigger. So be aware of that. That could change the investment timeline. And that's why some people debate about which is better, which one they want to do. But it has been popularized a lot recently. You'll see them all over the place. But you'll have to be an advocate for yourself whenever you're investing into these type of deals.
So here, in this case, this is not a safe because it's a valued round. And the valuation is 15 million post money, and we got a 1.5 million application. Now, we may choose to raise less than that if we want to, but we got a maximum of 1.5 million allocation. And just like Brendan said, this one is a convertible note. That means we will get the equity at 15 million post money, but we get to choose when we want to convert it'll go in as a loan, and we choose when we want to convert that into an equity round. And usually that's a way of de-risking it. So we want to come in now, but we want to convert it when we see the next round being raised. Until then, we will be accruing 6% or so annualized interest on our loan. And that interest will also be converted into future shares. So that's the vehicle we're using, 1.5 million at 15 million post-money valuation. And 25,000 is kind of like a minimum investment in this case. Preferred is 100,000, but we are also letting in a few people at 25,000. There's a one-time management fee. It's going to be roughly 2%. That's what we are expecting it. And it's one time because it's not an actively managed fund. Money comes in, goes into this company, and we wait. And if it produces a positive return, the money comes back and it's distributed back to you. So that's why there's only a one-time, not an annual management fee, one-time management fee. And then if we generate profits, 20% of that is how we, as general partners who run the fund or the syndicate, that's how we make our money, is the 20%. So we are all kind of all in on this. There's no money for us if you don't make money. That's another reason why we really like this whole. So our skin is very much in the game. So we have been putting in 4 months of effort, for example, in raising the money. But all of that will mean nothing until and unless this actually generates profits for our LPs. You want to add to that, Ryan?
So one question I had when I first started looking at these types of companies is $15 million valuation. Don't I want to invest in companies with a huge valuation? Is that better?
Yeah. A lot depends on the appetite. Some of these companies will not even see a huge valuation because if you look at this company, for example, when you invested 15 million, when we look at their pipeline, they have a significant pipeline. And we looked at their conversion ratio of how they're converting their pipeline into revenues. We estimate that they will be able to generate about 20 million or so from the existing pipeline in terms of ARR. So we said, let's sandbag those numbers. Let's say they don't do 20 million in 1 year, but they do 1/3 of that, roughly 7 or 8 million over the next 3 years. So we sandbag the number, the time and the amounts, and we made them almost 10 times worse. And at that growth rate, they could see a potentially $150 million. We won't be surprised if somebody acquires them at 150 million at that point. So this company did not even become very big for you to invest in future. But somebody who invests now already made their 10x returns. So that is a funny part about these early stage startups is you can make 5-10x returns in 3 to 7 years, and potentially you're in and out even before anybody else has an opportunity to get in. So if there are people saying, oh, I want to wait till it's a safer investment, it's a multi-billion-dollar company, I think they would have missed out on every company that I have invested in, because they all exited at 150, 200, 300, 400, 500 million. So they would have all been missed. So that's the funny thing about these kinds of early stage startups, is you can actually get in and get out, and they're not even on the radar of many investors.
Yeah, and a big thing about the valuation for investors to understand is kind of understand how it changes the behavior of the company itself. So if the valuation is extremely large, that company is kind of incentivized, kind of demanded to grow at all costs as quickly as it can, even if, maybe it's not wise to maybe hire like 65 people in a new department. It's just, well, our valuation is 150 million, so we have to hire these people right now. So that's a big, decision that company founders struggle with. Well, I should totally go out and raise 40, 50 million more dollars. And now that's really hard in this current environment. But as soon as you do that, there is the pressure of different additional investors who are all asking you to do things. And that can cause some people to trip too, if they raise too much money and get the wrong type of investor.
And we cannot do syndicates. Right now we are raising 1.5 million, but imagine Frontier X was raising money of, I don't know, $200 million at 1 billion valuation. They won't even come to us. They will usually go to large venture funds to raise that kind of cap. So there is a sweet spot generally for syndicates like us, which is generally between seed stage and Series A. So that is the stage we focus on. And that's why we have a set of criteria. We only invest in that part. We specialized in that. We know how to pick companies there. And we know, and based on the experience, we can guess that we have a roughly 10x returns in 3 to 7 years. So no guarantees, but that's what we specialized in. We just stay focused on seed stage to Series A.
Yeah. All right. So a few questions from the Q&A have come up. So Kenneth Lombardo asked, are there any tax benefits to these investments? So I'll speak first from the self-directed IRA side, and then people usually want to know, imagine there is no self-directed IRA. So on a self-directed IRA, most people try and do these types of startup investments through a Roth account. And the reason why is, if you're trying to hit for like a 10x or a 5x or something like that, a lot of people say, well, I'd kind of like to pay, the tax now and get it over with, and then try and get a really big Roth IRA. If you have a traditional IRA and your taxes are already really terrible with your CPA, we just went through tax time, it's still fine to do startup investments through a traditional IRA. Just know that you will pay ordinary income taxes on that. But most investors spread that out over, let's say you have a 5 or 10x. They don't suddenly take all of that out of their traditional IRA in the same 3 months. They'll do 40, 50,000 1 year, and they'll have their big nest egg, and they'll slowly draw from that over time. So for both of you, are there any, like when you're not in an IRA, a lot of people, they might be real estate investors and they think of like depreciation or capital losses or stuff like that. What types of tax stuff comes from these types of investments.
Ryan, you want to take that? You might be better at that. I do have an answer, but mine is very commonplace.
Yeah, so I would say there's no underlying physical asset that we're going to be depreciating on this one. I would say this is not anything that's going to provide any tax benefits outside of an IRA.
Okay, got it. Yeah, and that is a really unique real estate thing. So sometimes we have real estate investors, they're always asking that question. Physical assets do have those depreciation advantages outside of an IRA that others do not. So someone had a good question is, how are you finding these companies right now? We kind of talked about your philosophy a lot today. And is there any particular like industry that you are both focused on like right now?
In my case, it's been early stage tech startups because I'm a technology guy, and after having built and sold a tech company, just organically because of my communities where I belong to, many startups started coming to me, and I also give frequent lectures on and webinars to early stage startups that come out of IIT, where I went to school, and there are tons of startups coming out of there. We are also connected to, just like we specialize in post revenues, there are funds that are specialized in pre-revenues. So the way they make money is if we invest in 10 companies to get returns, they invest in 30 or 40 companies because the risk of loss is much, much higher for them. So we partner with them because when they invest in these 30 or 40 companies, there are probably 3 or 4 or 4 or 5 that are doing extremely well a few months later, and they're generating revenues. And we are partnering with those companies to send those kinds of deals to us. And yeah, so deal sourcing, as it is called, is not easy, but we do that because we are in front of potential startups, advising them, guiding them, helping them, putting content out, sourcing deals from various universities, pro bono mentoring. So there are a variety of approaches that we use to source deals. And we are also connected with several startup advisors that send us deals. And then, but it's interesting because for every 100 deals, we might pick one. For every 200 deals, we might select one. So the ratio is really, really small. And in tech startups, it's been very broad range. Like you've seen, gaming has been is one of them. Healthcare has been another. Technology, video streaming has been another. Music app, yet another one. Telecommunication. So within technology, we are very, very broad based. So long as we understand them. So I understand technology and its applications. So long as we understand them, and I'm able to articulate them in a very simple way for other people to understand, and it satisfies all our crazy checklist of criteria, then we move forward with it.
Yeah, and that I think that's one of the deal flow is one of the biggest differences compared to the public markets. A lot of investors might be used to is for deal flow in the public markets is, well, you just like look through what the top stocks are, and that's a really list with tons of public information on that that's freely accessible, available on every free website in the world. When it comes to something like startups, something like Kanth is doing, mentoring universities, flow, it's really, Kanth, you're trying to almost like be in touch with hundreds of different people that might see a bright startup or a diamond pop up, and you need to be able to be alerted when one of those is there, so you could have a further meeting and do more due diligence on them. And some of that, frankly, is a lot more old school in our technological age. If you just try and Google all these companies, you'll probably be, Ryan, you were talking earlier, like you're so overwhelmed, it feels like you're blind and you're just, throwing darts blindly. You do need in the alternative space to be a bit more social about it, or networking about it, or you need to rely on someone else that is plugged in to help you do that for you.
One question I had, Kanth, earlier you were talking about what the exits look like on some of your previous investments. What are some potential ways that you see liquidity events or exits with Frontier X specifically?
It's very difficult to predict what can happen. The most likely exit, I would almost put it as 90-95% chance, is they will get acquired by somebody large in that space. If, for example, Okta is a public company in the security space, somebody like Okta could acquire them if it is a couple $100 million of acquisition. If it ends up having a larger run to grow, it might be worth a couple of $1 billion, and in which case it might be acquired by companies like Microsoft or Google or companies of that ilk, which are very large and can afford to acquire multi-billion-dollar companies. So that is a second possibility. And typically the way these happen is, and that's what we are guiding these people in, is like Quick, one of the other companies I had invested in, had a partnership, and that partnership led to an exit, right? So they brought on board, Andreessen and Horowitz as investors early on. This was before Andreessen and Horowitz started their fund, A to Z. This was in 2008 or so, just before they started their fund. So they came in as personally investing their own money into Quick. And when they saw Quick growing, Andreessen and Horowitz were on the board of Skype. So they told Skype to acquire this company. So typically that's how things work, surprisingly. And Quick, the company we had invested in, got acquired for $150 million. So it could be again, it's not $1 billion company, etc. But we got into the first round at $3 million valuation. So it turned out to be a 50x, for example. So things can become pretty good depending upon what exit you get. So that is one way of looking at it. The second is, I know of people that invested in Carta early on and through a syndicate. And in Carta's case, it's not going to be acquired. It's huge. It's worth multiples of billions of dollars. And Carta is looking at going public. And some investors that invested through syndicates lost their patience, saying, how many years do I have to wait? So they sold the entire syndicate to a larger syndicate. So imagine the valuation went from, I don't know, if they invested at 100 million and they went up 20 times to 2 billion. And when Carta was $2 billion, they sold their syndicate. They had invested $1 million. Now it is 20 million. They sold the $20 million worth of shares to a larger syndicate, which bought them over. So that is another way of exiting. And the less likely way of exiting is when a business becomes extremely profitable, but they don't see any acquisition or going public, no liquidity event in the horizon. You will see dividend payouts, but generally does not happen in technology companies. They happen exceptionally. So those are the normal exit. So either acquired, or your syndicate can be sold in a secondary market, or there is a potential cash flow paid out via dividends, or the company goes public. I mean, if you're really lucky, if the company goes public, you're looking at making 100x to 1000x returns usually, but it is a long wait.
Yeah, and again is my point of, just as the deal flow sourcing is like more networked based compared to if you need to sell a private stock, that is like networking in the private markets. And the public markets, you click a button and TD Ameritrade, sorry, they don't exist anymore. Fidelity, Vanguard, or Charles Schwab, you click a button. They got acquired, actually, TD Ameritrade by Schwab. You click a button and someone buys your stock in less like 15 milliseconds. In the private markets, Kanth, you're talking about this larger syndicate. Did that could have taken 6 months to get that from start to finish, or maybe even most of a year.
1 year.
One year to, from, hey, we want to make this decision, let's float this idea, to, hey, I'm finally getting my investor money. So just as an investor, especially in retirement funds, you have to understand if you're in the private markets, your liquidity could be low for the next 3 years, the next 5, could be 7 or 8. So definitely understand that, these are dollars that might be out of play for quite a while. And for some investors, that works perfectly fine. For other investors, they're not comfortable with that lack of liquidity. or they are not ready for that. So they might need to consider going into a much later stage company or a company, the multiple might not be nearly as exciting, but the liquidity options for the next 2 years are much more realistic and known compared to something where there's a large unknown where you might have to wait 2 more years to get that back.
And Brendan, that's the reason why we are also informally guiding them. We might take formal positions. Sometimes they're all in the disclosures of the documents, but generally we don't take formal positions, but we're generally helping these companies we invested in. So we really want them to do partnerships. For example, another company that I was mentoring called Gravitant early on created a partnership with IBM, and a lot of their business came through that partnership, and IBM ended up acquiring them probably at 100 million or so, sub 100 million in valuation. So that's what we're doing very early with this Frontier X. Is I already told you about the law firm, McDermott, Will, and Emery. That's one of the channels. The second channel is a blockchain company called Avalanche, and currently they're exploring a third channel called Pegasus, which is a startup program of Microsoft. So when you establish partnerships early on, and one of those partnership channels ends up generating a lot of revenue, there is big incentive for the parent company to acquire this. So but by now, we are also using our playbook to help these companies grow in a direction that makes acquisition automatic or easier in the future.
And staying in touch, I think that's one of the most common questions we ever get in a self-directed IRA is someone invests in a startup either directly or through a syndicate, and then they have a question of, hey, my skills are actually really good to work on this startup or to help out with some of their business. And you can do that to an extent, but be extremely careful if you are paid or compensated, because once you own over 10% of a startup, there are IRS rules that start coming into play. And then 50% is the other big rule. Most people usually never hit that one. But one of the most common questions we hear almost once a week is, I'd love to invest in a startup through my self-directed IRA, and they also offered me a seat on the board. You really have to be careful about that. You could talk to us in our sales line or we have lawyers that we can recommend if there's a really complex but important situation to you. And then if you invest in something where you're so small, you're below 2% or 1%, you frankly really don't ever have to worry about this. You can take any position you'd like in the company as long as you're not the CEO leading it. All right, we are at time. So Kanth and Ryan, how do people get in touch with you? What's the best way to get in touch? And if we need to pull up the slides quick again, just to put that in the chat as well.
Yeah. Let me just go back to that. Okay, there is ryan.beatty@opika.co. You can reach out to Ryan there. You can take a snapshot of this, just take a picture of this slide, and please feel free to reach out to Ryan.
And we will be, this will be up on YouTube in 24 hours, usually a bit sooner than that if you wanted to share it with anyone else. Thank you everyone for stopping by today. Info@Rocket Dollar is where if you need to contact anyone at Rocket Dollar, or if you need another contact, but there is Ryan's email if you'd like to get in touch with Opika. All right, thanks everyone.